All right, it's that time of year again, tax season. And for a lot of us, that word alone can bring on a bit of a headache. But what if I told you that one of the biggest, most common fears about taxes is actually just a myth? Today, we're going to pull back the curtain and show you how your taxes are really calculated. You might be surprised at how much sense it actually makes. So here's the classic worry, right? The one that maybe keeps you up at night. You've worked your tail off, you finally get that raise you deserve, but then this little voice creeps in and says, "Oh, is this extra money going to push me into a higher tax bracket and somehow leave me with less money in my pocket?"
Okay, deep breath. I've got some really good news for you. That fear? It's based on a massive misunderstanding of how Canadian taxes work. So today, right now, we are going to bust that myth wide open. Let's do this.
First up, let's tackle this head-on. We're calling it the Great Tax Bracket Myth. We need to separate the fear from the, actual reality.
You've probably heard this one before, right? Maybe you've even thought it yourself. It's this idea that as soon as your income crosses some invisible line, bam, a huge new tax rate gets slapped on your entire salary.
Let me just be crystal clear on this. That idea, it is completely 100% wrong. It's not how it works, not even close. Getting a pay raise will never, ever result in you taking home less money.
So if that's the myth, what's the actual story? Well, it all comes down to something called Canada's progressive tax system. And once you get it, you'll see how it's actually designed to be fair. Okay, this right here is the golden rule, the absolute key to understanding everything. Yes, as you earn more, the tax rate goes up. But, and this is the part everyone misses, that higher rate only hits the money you earn inside that higher bracket. Think of it like filling up a series of buckets. You have to fill one completely before any water spills into the next. So here they are. This is basically our roadmap, the federal tax brackets for 2025. You can see there are these different levels or buckets, and each one has its own tax rate, starting at 14.5%. I'm going to say this again because it is the most important thing to get. Your entire income is not taxed at your highest rate. Only the dollars that fall into a certain bucket get taxed at that bucket's rate. That's it. All right, theory is one thing, but seeing it in action is way better. So let's crunch some numbers with a couple of examples and see how this all plays out in the real world. Okay, first up, let's meet Giovanni. He's a student, worked part-time, and his taxable income for the year is $10,000. See, for Giovanni, it's pretty simple. His whole $10,000 fits nice and neat into that very first tax bracket, that first bucket. That one's taxed at 14.5%. So you just do the math. 14.5% of $10,000 is $1,450. That's his starting federal tax. Easy peasy. Okay, simple enough, right? But what happens when you earn more? Let's meet Maria. Her taxable income is $115,000. Now, this is where the myth gets busted, because her income is going to fill up the first bucket, the second bucket, and even spill a little bit into the third. And this is where you really see that bucket system work. We do not just tax her whole salary at the highest rate. No way. We do it piece by piece. The first $57,000 or so, taxed at that low 14.5% rate. The next chunk of her income, up to about $114,000, that's taxed at 20.5%. And then only the tiny little bit that spills over into that third bracket, just $250, is taxed at the higher 26% rate. So you add up the tax from each of those buckets, and what do you get? A total federal tax of $20,146. The key thing to notice is that even though she's in the 26% bracket, her overall tax rate is much lower than that, because most of her money was taxed at those lower rates.
Okay, so we've calculated the basic tax. But wait, there's more. The story doesn't stop there. Now we get to talk about the good stuff, how you can actually lower that number.
Think about it like this. Once you have that first tax number, the one we just figured out for Maria, you then get to subtract things called tax credits. And this is where you can seriously reduce the amount you actually owe. And you'll hear about two main kinds of these. You've got your non-refundable credits, which can knock your tax bill down, maybe even all the way to zero. But they can't go below zero. Then you have refundable credits. These also reduce your tax, but if they're worth more than the tax you owe, the government actually cuts you a check for the difference. Pretty cool, huh? And just a quick heads up on one last, really important piece of the puzzle. Everything we've been talking about, that's all for your federal tax.
You also have provincial or territorial tax, and it's calculated in pretty much the exact same way. It just uses its own set of brackets and its own rates.
Whew, okay. I know that was a whirlwind of numbers and brackets, but honestly, it all comes down to just a few key things to remember. Let's wrap this up with the big takeaways.
First, remember Canada has a progressive marginal tax system. Fancy words, but it just means we use those tax buckets. Second, and say it with me now, your entire income is not taxed at your highest rate. Only the money inside a higher bracket gets the higher rate. Which leads to the most important point of all. Getting a pay raise will always mean more money in your pocket. Always.
And that's it. The great tax bracket myth, busted. You now get the how of calculating your federal tax. So that old fear of getting a raise can be replaced with confidence. The only question left is, now that you know how it works, what will you do with that knowledge? Maybe it's time to start thinking less about just filing your taxes and more about actually planning them.